Is Tuesday, but there's still a lot of M&A to talk about.
Merger Tuesday.
Yep,
yeah.
Merger Tuesday. Although this one's been like in the works for so long now. Warner Brothers, Paramount, Netflix. Looks like Warner Brothers is now open to a Paramount bid, a little bit more open than it was before. It is reopening talks with Paramount as Paramount signals a higher bid, but has not actually raised
I'm glad
its bid.
you reported it correctly, because they haven't raised their bid.
No,
They're
they
saying,
haven't. They said, we could.
Yeah.
So I guess that's good enough for them to reopen discussions. Stephen Flynn is our senior credit analyst on this developing story. So, Stephen, how are you looking at this development?
Yeah, so you think back a couple of weeks ago, on February 10th, Paramount actually came out. They reiterated a $30 per share cash offer for the entire Warner Brothers Discovery, but they did add in a few other things. Number one, they said that they would pay the $2.8 billion termination fee that Warner Brothers would owe Netflix for breaking that deal. They said that they would help with the $15 billion of bridge loan that Warner Brothers has outstanding from a bond tender deal that they did mid last year. They'd also fully reimburse Warner Brothers Discovery for a potential $1.5 billion fee that Warner Brothers could owe certain bondholders if they do not do a debt exchange by the end of this year. So this is a complicated story that keeps getting more and more layers of complexity on top of it.
Remind us, Steve, if Paramount were to win this deal for Warner Brothers, this would be a very highly indebted company. You guys don't like that, do you?
Correct, yes. So Warner Brothers Discovery would have about $85 billion of total debt pro forma for this deal, a combination of Paramount and Warner Brothers, right? So Warner Brothers has about $31 billion of debt. Paramount has about 15. This deal would add about 39. So you're talking about 85 billion. If you just look at the combined EBITDA for both Warner Brothers and Paramount for 2026, combined, they're about $12 billion. Just basic math, you're talking 7 times leverage. That's obviously huge. But Warner Brothers, Paramount, expect about $6 billion of cost synergies. So if you give them credit for that, gives you about $18 billion of EBITDA. It still gets you well over 4 times.
Synergy credit. You guys are pretty stingy.
Well, yeah, we could give it, but we give you a certain amount of time to actually show it, right? Okay. So, and this is really important, because what will the rating agencies do? And for the $54 billion of debt financing that they have in place to support this deal, to what extent will it be ahead of the other debt through either guarantees and or security? So if you could argue that it is ahead of all the other debt, and you give them pro forma credit for the synergies, you're talking about 3 times leverage through that $54 billion, which could potentially get you IG credit ratings, right? So if we look at Charter as a comparable. So Charter, for many years, had a total net leverage target of 4 to 4.5 times, but they had a split capital structure. The secured bond debt was IG, the unsecured debt was high yield, and the secured debt, they kept that a little bit over 3 times. And so if you use that as a comp and give them credit for the synergies, you could say that
there's a lot of ifs there.
Yes, there is. There's a lot of ifs
Plus,
there.
I like Charter's cash flow better than I like.
Yeah, but pro forma Paramount, Warner Brothers should generate a lot of free cash flow, and they should, I assume they will, commit to use all that to reduce the debt. And typically, rating agencies will give the company a few years to kind of hit their targets and show the deleveraging.
So Warner Brothers, when it merged with Discovery, also took on a lot of debt. How does this potential Warner Brothers and Paramount debt profile look compared to what Warner Brothers looked like after it merged with Discovery?
In total, when thinking about the leverage, it's not too different, but let's hope that this works better, right? So, because
that's the question, right? Last time it didn't work so well, and Zaslav was kind of just preoccupied with bringing down the debt for years.
Correct. So when they merged Discovery with Warner Brothers, they purchased it from AT&T effectively, and it had a high leverage, and they promised to delever, and it did not delever as quickly as anticipated. So then that's when last summer you had the whole announcement of the split, and they decided to launch a tender offer where they got some new financing in place and told the existing bondholders, we'll buy the bonds back from you. But you're taking some pretty big haircuts to the amount that you're owed, and they still had very good participation. So that helped them delever a little bit, and then they put themselves up for sale, and we've had all the mergers since then.
Let's load up on debt again.
Let's load up on debt again. We've seen this play before. Steve, thanks so much for joining us. Steve Flynn, senior credit analyst for Bloomberg Intelligence, covering the whole tech, media, telecom space. And again, Warner Brothers presumably opening up for a period of 7 days, more negotiations with Paramount.